Yes, these hybrids.
hmm
Right, yes. Welcome, everyone. Let me go ahead and get started since I don't want to keep everyone on for any longer than the 20. Again, everyone, welcome to another Power 20 by 5,000 Keys. Today, we're discussing one of the most important topics for both new and experienced investors, and that would be the five biggest mistakes passive investors make. The truth is, most investors don't lose money because they lack opportunities. They lose money because they make some avoidable decisions before they invest. Today, we're going to share the mistakes that we've seen investors make, how to avoid them, and simple framework or questions you can use before evaluating your next investment opportunity. As always, today's discussion is educational only and should not be considered legal, tax, accounting, investment, or legal advice. All right. Okay. Let's see. Investing without knowing your goals. Christina, what would be the biggest mistake you see investors make?
That is a great question, Kristen. And a lot of times what I see the biggest mistake is investing before defining what does success look like and what is it you're really trying to accomplish. The first thing I hear people ask anytime I bring any type of opportunity to them is, well, what's the return? What's the return? What are the KPIs? Before, what you should really be asking is, well, what is it that I, as an investor, am trying to accomplish? Because there's so many different ways that investments can help you. Every investor needs to first determine, is it cash flow that you're after, today money? Is it appreciation? Are you looking for tax advantages? Are you looking long term, passive income, retirement income? Or are you trying to build legacy and have wealth preservation for future generations to come? And so, what ends up happening is without really knowing what your true destination is, we tend to get a bit of ADD and we want to get involved in everything because every starts to look attractive when you haven't defined the lane that you really want to invest in.
So, what's the first question investors should ask themselves?
Simple. The number one question you should ask yourself is, what job do I need my money to do? Right. So, for example, when I invest in fix and flips, it's because I want short term higher returns. When I'm investing in multifamily, it's because I'm looking for long term passive income. So, once you know the answer of what is it that you want your money to do, then evaluating opportunities becomes so much easier and so much clearer.
All right, thank you. All right. Leah, one question for you. What's another common mistake?
I think a common mistake investors make is focusing on projected returns instead of the actual people managing the investment, right? Like the operators. Like for us, for instance, a great operator can definitely navigate challenges,
Mhm.
but a weak operator can absolutely destroy a great deal, right? So people invest in deals, experienced investors invest in operators. I mean, I think it's really important to know who you're working with and who's operating the deal.
All right. And what should investors ask?
I think some of my favorite questions are, what's your experience? Number one. Number two is, how do you communicate with your investors? Number three, how have they handled challenges in previous deals? And how your interests align, how are your interests aligned with the investors itself? And the answers really tell you a lot about the team.
All right. I agree with that. Thank you. And Julie, from an operations perspective, what mistake do you see?
That's a great question because, we typically, everyone, when we look at a deal, we're looking at the upside, right? We want to know our returns, and people tend to ignore the downside. So, what do I mean by the downside? So, every investment, as we know, carries risk, right? But when you're a great operator, what you're looking for and you plan for is the risk in occupancy, the market, interest rate, renovations, always something. I mean, who in here has ever done a renovation that's been on budget and on time, right? And then the exit strategy. So when we look at this and we look at risk, we need to take all of that into consideration, not just the upside, but what's the downside in this particular investment, right? And if someone's only asking about the returns, you want to be cautious. Like if all they talk about is a return, you have to mitigate risk.
All right, thank you. Yeah, a project on budget and on time?
Yes.
Who's that? I want to
Rarely
know who that is.
happens.
All
And if it
right,
does, I want to know about it. I want to know your
exactly.
secret for sure.
What's a great question investors should ask?
In regards to, the risk, something that they want to ask is, if you're going to invest in this deal, like what can go wrong, and if something is going to go wrong, what's your plan to mitigate those risks? So, we try to control as much risk and mitigate as much as possible, but we still want to have, being in the military, we have plan A to plan Z. So you need to understand what you're getting into. Okay, so if this happens, what's your plan? If this happens, what's your plan? So. That's one of the things that I see on an operational side.
Okay, that's a good key advice right there. All right. Let's see. Mistake. What is that? Three mistakes already?
Hmm.
Christina, what's mistake number four?
This one's my favorite and probably one that I did very early on as an investor, and that's investing emotionally, right? Because we all have FOMO in life, and investing is no differently, right? You never want to invest because you're afraid of missing out and everybody else is doing it. You want to be careful not to get in on the latest trend because right now RV parks are hot. So how come I'm not investing in an RV park? Um, you never want to invest because someone pressured you. Like think of those timeshare people and those gurus that sit you in a room for 6 hours until you sign that timeshare. Um, Also, never invest money you may need next month. And I think that's one of the biggest key learnings is sometimes people will say, I want to put 50,000 into this project. Fantastic. But if you might need that money next month, don't invest it because when you're putting money into projects, it's meant to stay there for the duration of the project. The best investors are they're disciplined and they're patient.
And how does someone know if they're investing the right amount?
That's a very interesting question, and it's simple in terms of ask yourself, if this investment takes longer than expected, would I still sleep well at night? And I'll give you an example. I did a fix and flip with someone recently. They were supposed to have the payout in January. Well, unfortunately, we know things happen, project get delayed. I know the payout's going to come, but now here I am 6 months later, and I'm okay, right? I can still sleep at night knowing that that money will eventually come. It's not going to hurt my finances in any way or my liquidity in any way. But if an investment is going to take longer than you expect and it's going to hurt you, then the answer is no. You're probably investing too much. So make sure that the money that you're investing is something that you're comfortable that there will be delays because this is real estate.
All right. And I think I cut somebody off. I'm not quite sure. Did somebody else have a question? No? Okay. I'm hearing things. Cool. All right. What's the final mistake? This is should be the fifth one. Yeah.
Want me to take it or who wants to go?
Oh,
I
okay. Well,
don't.
I guess I'll take that one. I mean, failing to perform due diligence. That's probably the
Mm.
mistake number five that most people jump in. Like, let's use an example. You get a rent roll and you get a T12 from the seller or the seller's agent, and you're like, okay, great, numbers pan out. But you really have to go back and triple check, double check, dot your I's and cross your T's. So taking the time to perform due diligence is so important. And so, let me give you another example. Many people, not only investors, we spend more time researching a vacation than we do researching an investment, right? We'll sit there and we'll take hours to check the destination. What are the things I'm
Oh my
going to
God.
do? What hotel am I going to stay at? Even down to what outfits will I pack?
Great.
But I think a lot of times people don't treat an investment with that same type of tenacity. So before investing, you really need to understand what is the market that this investment will be in? What is the business plan to make sure that the numbers are delivered? What are the risks and what is operating do to mitigate these risks? And what is the true timeline from a best case to a worst case? right? Because all timelines are kind of indicative. So I always like to ask that. Okay, you're telling me it'll be done in 6 months, but truly, what's the worst case scenario if something goes wrong? And so those are the types of questions you really need to understand because it's truly about education first. That needs to come before you invest.
Right. I agree with that wholeheartedly. Leah, what does good due diligence look like? Just kind of piggybacking off that question.
Sure. I mean, I would do so it doesn't matter what the asset class is, you always want to do due diligence. I mean, for me, I have a fix and flip business as well, and due diligence is key. You definitely want to ask a lot of questions for one. Review all the documents. I mean, don't be like me in the beginning where I rushed through the documents. Now you got Chat GPT, you can run it through Chat GPT, double check that, right? You always want to understand the assumptions. Definitely never, ever, ever feel rushed doing through this whole thing, right? Because that's the worst thing you could do. And a good investment opportunity will still be there even after you've completed your homework, right? So there's
Okay.
that. In fact, I think we do have an investor checklist, 5,000 Keys does, that we'd be happy to share.
I think that'd be really helpful. I'm pretty sure people on this call would appreciate something like that. All right. We are doing pretty good on time, everyone. I just kind of want to open the floor to anyone that has any other questions besides the five that I've asked. We're here to help and educate.
I'll ask
Good little
Peggy.
group today.
Peggy, how are you? It's so good to see
Yes,
you. It's
Peggy.
been like forever.
I know I'm trying to get myself back into the groove, but I missed you guys.
Oh, we miss you too. What concern? I mean, like, what are some of the mistakes? We've hit on five of them. Any of those resonate with you? That in
I
your
think I think the biggest thing I've learned through like the last year and a half of investing is that nothing ever gets completed on time.
Yep,
yes.
definitely for
So
sure.
that is something that I'm learning. And I mean, the other thing is, I could ask you ladies this is are there deals that actually are closing on time? Am I on the wrong deals? Or, did I not do the right due diligence? Because a lot of the deals are tied up now for a lot longer than expected. So yeah, there's, those kinds of concerns. But I think someone mentioned about, can you sleep at night knowing I'm fine. Like it's not money I need right away. However, eventually, I've got two kids and things happen, car breaks down, or these things come up. So eventually I do need that capital back, so I can continue to also invest in other things. So yeah, it's a little bit of a trying to see what more due diligence I could be doing in the future. But also the general feedback I'm getting from a lot of people is that yeah, nothing's gonna close in like 2 months, 3 months.
Yeah.
It's like double that, triple that. Yeah.
I'm going to chime in on that. Maybe I'm lucky. So, first of all, I wanted to piggyback on what Christina said, and we talked about this last week. Never invest money that you can't afford to be without, right? We talked about that last week, and it keeps spilling into the next call after next call. But as far as projects being completed on time, I will have to say, and this has nothing to do with multifamily, but on my fix and flip business, out of the 12 acquisitions, I'm happy to say that eight of the fix and flips that we've completed, out of the 10 or 11, eight of them have completed on time. Only one, it was completed on time, but because it didn't sell, we're not counting that. So, yes, there are
Okay.
still those deals.
That's great.
Yeah. But anyway,
Fantastic.
so they're
Awesome.
still there.
Mhm.
And I
Well,
think it has a lot to do with having the right contractors too, right? Having the right team makes a big difference. Yeah.
oh yeah, like you said, knowing who you're working with, can people be relied on to get like things done for you and stuff like that. That's actually really important. All right.
People,
Actually, I have
people,
another
people.
question.
Go for it.
Have any of you ever invested and later regretted something?
It's a very good question. I'll
I
take it.
have.
Um, so regretted a little bit because it was on me because I didn't do enough due diligence. So when I first started, this was before Paces World, where I invested in, with someone on a woman's real estate network. Uh, they said knowledge is power, right? So what I know, what I didn't know until joining Paces Gator and knowing how to protect myself and how to protect my money before protecting anybody else. So, no, I wouldn't say I regretted, but I took it on me that I didn't know everything and I didn't do enough due diligence. I'm just like, oh, you trust, and Pace says trust but verify. So that has stuck with me from now on.
Yeah.
A good
I think we may
keynote.
have all
Trust
been
but
there because
verify.
that was me too.
Yeah.
And I've done the trust and I've done the verified, and there was still one that didn't pan out. But lots of lessons learned.
Mhm.
I'm still licking my wounds.
Yeah. I think Erica has a question in the chat.
Oh,
Is
Erica is saying, as a newbie, I'm struggling with order of steps for first deal. So can we give some advice here?
What do you mean by order of steps for first deal? And what type of deal? I think that'll help us to frame the answer accordingly because it's going to vary. Can you
Okay.
give us an
Thank you so
example,
much,
Erica?
ladies, for your time and
Of
your advice. I
course.
really appreciate it. So, focusing on co-living, sorry, sober house. I have an operator that has experience. Um, I need to figure out the corporate structure, holding company, business company to hold the asset, and then operation company. So they're separate. Um, and then how do I structure this particular deal to sell their finance property? It's perfect for our application. Um, I've done all my underwriting, but the capital that's needed is way too much. I'm not able to borrow that capital and still be able to cash flow. So kind of structuring that deal, I'm kind of I feel like I've put the cart before the horse. I found the property, but I'm not corporately set up structurally. Um, and I feel like I'm doing it on my own. I'm like, I'm not scared to do it. I just want to do it right. I'm in Florida, so I think I'm supposed to be putting that piece of property in a land trust. So I just have a lot of questions. Like, what do I do first?
I think those are all great questions. And, in terms of company entity structure, we're not really the experts to say that without going into the detail. I would say first and foremost is have a really good real estate attorney and make sure that you're setting up everything accordingly. But I do want to pick up on one thing that you said that I would say is a big caution. It doesn't cash flow if I were to borrow the money. Whatever funding avenue you decide to go, seller finance, a hybrid of Morby method, DSCR loan, if it doesn't cash flow, that's your answer right there, right? Because unless you're a not for profit, you want to make sure that the property is paying for itself at least within the first 3 years. And eventually the cash flow will come. You might have single digit in the first few years, and that's fine. Because I mean, people who think they're going to get rich off of one deal are not doing the right thing, right? Because we all wish we could just get rich off of one deal, and that's not the reality. But if the property or the project itself doesn't cash flow, that kind of tells you that's maybe not the right project to start with.
It's cash flowing at, let's say it brings in 9,000 after debt service, we're at 5,000, but he wants $75,000 cash down to do the seller finance piece. So if I renegotiate it where I bring 35, then at that number I could borrow 35 or 45 and I'm still cash flowing. I can't cash flow at the 75,000 cash that he's asking.
Then maybe negotiate that in increments. Give him the $30,000 cash down and give him the other 35 or 45 and you after year one. But you definitely want to make sure that you protect your cash flow in the first 3 years because things will come up, other expenses that you don't anticipate. And I think that's the most important thing in terms of first steps is structuring the deal, that you
Mhm.
make sure that whatever avenue you have to pivot, like, having to go after getting other people's money for the down payment, do your numbers still work? And I think that's going to be really important. And once you find that out, then yes, having your entity and everything set up properly, making sure whomever you're working with, you've got the roles and responsibility clearly defined so that people know exactly what they're expected to deliver and how to support in terms of this. Because what you don't want is to be in it and then trying to figure out what everybody's supposed to be doing. Right.
Oh,
So,
yeah, I think I'm confident with that piece, the operations piece. It's
fantastic.
just structuring the deal. So I could essentially, like you said, just reiterating, structure it where it's 35 in the first year and then the remaining second and third year. So I'm essentially asking the seller to finance the entire deal at that point.
Correct. Correct. And you're doing it in lump sum or increments. Yeah.
Okay. And what would be an appropriate percentage?
Well, it depends on your purchase price. I mean, I typically start at 10%, right? If it's a $500,000 purchase, and I'm saying I'll put $50,000 in terms of down payment. And I think if you can kind of start there, that's not a bad place to start because it's industry norm. It's not out of line. Otherwise, if you're going to be
Uh,
putting 25, 30% down, then you'll be going to a bank unless he's going to give you favorable rates.
Right. And that's what he's asking, 20%. So I could try to get into 10% is
You
what
could
you're
do 10 and
saying.
10. Yeah, you could do
Okay.
10 and 10.
Okay. And then that 10,
Oh, you
Oh,
went on mute, Erica.
I'm sorry, um, that those increments at which interest rate is fair. I was thinking 6 or 8% interest rate.
I would try to go lower. If you're doing a seller finance, the important part is you want to be advantageous to market, right? So you need to be below market
Below market on the interest rate. Okay, because
because it's
he was
also a benefit.
offering,
Yeah. Don't forget when you do a seller finance, it's also a benefit to the seller because they're not taking a huge tax hit on day one because they're getting paid in installments. They're not getting paid. They're not having to pay taxes, the capital gains tax on the entire sale price. So
okay, all right, excellent. Yeah, he was offering 5.5%.
5.5's not bad. Go back and counter at 4.5, and then meet
Okay,
somewhere in the middle. You're better off than 5.5 today.
thank you, ma'am.
Welcome.
really good question, Erica. Thank you.
I love case studies like that. Thank you, Erin. I'm the geek with numbers on the team, so
I love it. I love it.
All right. We're definitely a bit over time here. Just wanted to ask, no, no, that's not your
That's
fault.
me.
Definitely no. We just wanted to ask any like final closing thoughts, anything for the rest of the group to have. Yeah,
I'd like to
before
say
you.
if everyone remembers one thing about tonight's topic, right? We're talking about the five key mistakes. I would say before evaluating any opportunity in terms of an investment is first understand what your goals are. What are you looking for from the investment? Cash flow, depreciation, appreciation, tax advantages, etc. Right? Do you understand the business plan of the investment? Do you understand the risks and the mitigation plans? Very important. Do you trust the operators? Do they know what they're doing? And does this fit your timeline? Like when it comes to multifamily and our current investments, what I ask a lot of investors who say, Christina, I'm so interested, I want to put money in. I'm like, are you comfortable not having your money for 5 years? And if they say yes, then I'll say, great. Now this is multifamily. Are you comfortable not having that money back in 10 years? Like you continue to receive dividends and returns, but if you're not comfortable having your money gone, or invested for a long period of time, then it might not be the right investment. So make sure you understand your own timelines and are you comfortable with the amount that you're investing? Don't overextend yourself on any one investment because it's not as easy. Like people think I can just go and say, I need my capital back. It's not that easy, whether it's a fix and flip, single family, co-living, multifamily, it's not that easy. So if you can't answer all five of those questions, don't invest yet.
All right. That is a great point. And so for those who would like to see what a real apartment investment looks like, what can they do?
I would say join us for our case study. We have a case study, I believe it's Saturday. Is that correct, Leah?
Yeah, we're hosting it on Saturday and it will be at 7 o'clock, is it? Or did you decide on 6? I'm still
6 p.m. Eastern.
6 p.m.
6
6 p.m.
p.m.
Eastern.
Eastern. Okay. Yeah.
So we'll walk you through the specifics, a live case study on how we found the deal, why we're pursuing it, what is the purchase structure, the financing strategy, the risks that we identified and what we did to mitigate those risks, how we evaluate opportunities, because of course our focus is multifamily at the moment, and what investors should be looking for when reviewing multifamily investments. So whether you invest with us or not, doesn't matter. You'll walk away with a better understanding of how experienced investors analyze apartment deals. So we'll drop the link in our socials, if not below, and we would definitely love for you to join us.
Yeah, and just one quick thing, I'm just going to put in the side chat how to create everything that Christina said, how to do the personal investor criteria checklist. So your goals, your timeline, your returns, your risk tolerance, and this is kind of something that it may change over time, but at least get this started so you feel comfortable. Okay, so I just dropped that in the side chat.
Oh, you are dropping it. Okay.
Did it take? Did post it? Oops. You-
I thought I see it, but
Investor checklist. Yeah, I'll post it again.
and can
Perfect.
I also get the
So
registration link? For some reason, my thing closed, so I'm trying to get it back to put the registration link in there. But okay, anyway, perfect. Thank you everyone for joining us for another CLO's Power 20. We'll see many of you Friday, or I'm sorry, Saturday for the Don Quixote apartment case study. And I hope everyone has a fantastic evening. And I will try to get this link in here
And
real
we'll
quick.
have a session on Thursday, same time, 12 for the Power 20. Perfect. Thanks, everybody.
thank you,
All right. Thank
everyone.
you.
Thanks, everyone.
Thanks so much.
Thanks
Thank
for the
you.
jewels.
Thank you, guys.
See ya.
Thank you.